Welcome to the What to Watch video update. This is the last video that I do over the weekend where I pick out the charts and things, both positive, negative, and other things that I'm watching that really seem to be saying something right now. If you've watched other versions of this video, you see a lot of the same charts over and over again, but there are other charts that kind of come and go as we try to hone in on where are things going with the S&P. Now, we've been setting an all-time high with the S&P. We did on Friday and we did throughout this past week. But we're starting to see some cracks inside of the S&P and across the broader market. And we want to ask the question, will internal weakness take the S&P 500 lower? Now, we have a couple of good up days that could take care of this internal weakness, but this has been building over the last few sessions and we'll just watch it unfold. And I'll be updating this in the daily video that I put up, of course, each day. Okay, before I get into that, I want to tell you about the SPX investing program. It's up, it's going, it's free until the end of 2024. Feel free to check that out. You get immediate access to the videos as they're available. There's a basic course on there. I'm going to be rolling out a lot of new things in 2025. There are additional videos that I post on the website. There's a link that will take you to the website as well as to a video about the program. Feel free to check that out. If you have any questions, here is an email address. And also, the daily video is really where my analysis is. All of the other videos that you see around the outside, they're meant to tie into the daily video. But I know they're longer and I show a lot of charts and people are busy and this is a busy time of year. So I try to break it down in this video to just go through what am I watching as of right now, but that can change daily. All right, let's go through and look at some of the positive things. The first thing that we look at is a week ago, I brought this out in the video and I was mentioning it in the daily video. We saw a real convergence in the short term, intermediate term, and then long term by looking at a weekly chart of the beginning of a new trend. And that is measured by a thing called the ADX, the average directional movement. And that's the black line that you see here. And we were coming down below this level of 20. That means we're not trending. When we go back above 20, that means we are starting to trend. And when we're above this moving average, that means the trend is getting stronger. Well, we saw that here in the short term, intermediate term, and on the weekly chart that I'll show you here. Now, to determine if it's positive or negative, we look and see is the green line above the red line, which that's what it is right now. So this is positive. We want to see this continue to go up. We want the green line to continue to go up, and that would help confirm that the trend is positive. If this starts to really drop off, then that would be more negative for the trend. Here's the same thing with the intermediate term trend, and this is the chart I really focus on the most. Most of my analysis is around the intermediate term, and then I break it down into the short term and then long term, with the real focus being intermediate term. And my definition of intermediate term is weeks to months. We're also looking positive here, but we see the green line coming down just a little bit. And then this is a weekly chart where we're also crossing back above the moving average. We never got down below 20. Now, other folks that use the ADX, they'll use a different level, maybe 25, maybe 22 and a half, whatever. Over the years, I have learned for the S&P 500 that 20 is a pretty good level to look at. And this is turning back up. So we're seeing the beginning of a trend in the short, intermediate, and long term here. And right now it's positive. And you can see the green line on the weekly chart continues to go up. So we're still looking good longer term. We just may see some weakness over the short term here over the next week or so. This is also positive, where we see the blue line above the red line. We had seen the red line above the blue line, and it's okay. The market can still go up, but as growth has been outperforming value on the intraday chart, we're seeing growth really starting to outperform here as value has been going down. And this is a 10-minute intraday chart. Also, another intraday chart looks at a growth to value ratio for the S&P. In the latter part of November, we really started to come up out of this after we had been declining, and this is showing a lot of improvement. And this really helps the S&P 500 to go higher when growth does outperform value. This is an end of day chart looking at a growth to value ratio for the S&P. We were in an uptrend, but we were more or less chopping sideways. And we're in an uptrend because the blue line is above the red line. we're finally starting to break out here. And if that could continue to go up, that would be more positive for the S&P. And we look at discretionary versus staples. And back in August, when we had that big down day on August 5th, and everybody thought the world was coming to an end, since that time, discretionary has been the best performing sector, and that includes Amazon, Tesla, and that's really helping this ratio to really go up. And that's another growth area. When we see the tech sector, discretionary, and communication all really going up, the market is going up at that point. Those are real growth areas, and this is really helping things to look more positive as well. Large cap growth setting a new all-time high in Friday's session, and it's mainly being led by the large caps right now. We look at our growth to value ratios with the Qs to S&P showing some strength here. We're really seeing an improvement with discretionary to the S&P. Also, we're seeing where large cap growth is outperforming large cap value. So this is why the market is more positive. So we're looking pretty good here with the large caps, showing a real improvement with the mid caps as well as the small caps. Even though the mid cap and small cap indexes were down this past week, we're seeing some buying coming into the growth areas of those indexes. Then we look at a growth versus value ETF. We've been chopping around inside the rainbow pretty much most of the summer and into the fall. Well, now we're starting to break out and go up. So that's more positive also. And then I haven't been showing this chart for a while because it's been chopping around and not really giving us much of anything over the last month or two. This is a risk on to risk off ratio. When this is going up like it is now, that means the market is more risk on and they're getting into these high beta stocks like Apple, Amazon, Netflix, Google, excuse me, and stocks like that, which really drive the indexes higher. We look at the condition of the short-term trend as measured by the 20-period moving average. And this is a double and triple exponential moving average here. And they move pretty quick. And we see that the lines are going up and prices above the line. So the short-term trend is still looking positive. We also look at the condition of the intermediate term trend, also a double and triple exponential moving average here. Based on 50 periods, the red line and the blue line are going up and prices above both lines. That's positive in the intermediate term. Here's the 20-period simple and exponential moving average. This is what I use to define positive or negative. We're going up, we're above both lines, and the lines are going up, so the short-term trend continues to be positive here. And we look at a long-term rainbow, same type of thing. Moving averages from 10 periods up to 50 periods, all the lines are going up and prices above all the lines. Short-term trend is positive. Here's another set of moving averages here. We're above all the moving averages that are plotted and all the lines are going up. But we're maybe getting a little far away. And I use the boom indicator here, and we measure the distance from price to the 20 period, 50 period, and 200 period moving averages. And then we use this like an oscillator where we see extreme positive or negative readings. When we get a really high reading like we are now, we're getting a little far away from the 20 period, and we're also getting a little far away from the 50 period. Still looking pretty good and positive with the distance away from the 200 period moving averages. And the VIX has been going down as the S&P has been going up. It was really quite high going into the election, and then we saw that pop after the election, and then we just kind of drifted and even went down a little bit after that. Well, that's when the VIX started to go back up. But now we've been drifting back down. The line chart is the closing value of the VIX, and then we have a bar chart. We're getting down to a really low level now, which usually suggests good positive returns, but it also suggests complacency, and the market doesn't like that. If it just assumes it's going to go up, sometimes the market will throw a curveball at everybody. And we look at the momentum of the VIX, which it is still continuing to go down as measured by the MACD, but maybe we've gone down a little too far too fast. This measures how fast we're going up or down with the VIX and I plot an RSI based on 9 periods here, shorter term. And we're getting a really low reading right now, and that's extreme. That could mean that maybe we're going down a little too fast as the S&P has been going up. Then the trend channel. Now we're positive here. We're above the midpoint and going up. That's the positive side. Now on the negative side, we're hitting the upper end of this line here. Now we don't know. I mean, this goes back well into 2013, 2014. We actually broke above it in 2021. we're getting up to this line. Will this provide overhead resistance? So we're positive here and the things are going up, but we wonder if it's going to bump into this and run into some problems. And we're still looking good here when we look at the advanced decline line, but with the S&P setting new all-time highs, we're actually drifting lower based on price and volume. That's a bit of a concern. That just means that the mega caps, they're the ones driving the indexes up, but we're not seeing participation through all of the other stocks in the S&P, and that's a warning sign that we're keeping an eye on. Seeing a similar thing here. We are seeing many more new highs than new lows, but we're starting to turn down with our 5-day moving average, and we're already going down with the 10-day moving average. So this is still positive, a lot more green than red, but the fact that this is rolling over and we're seeing a bit of a drop off here with the new highs and a bit of an expansion with the new lows is just something we want to keep an eye on. Then this is a smart money indicator, accumulation distribution. We're above the moving average. That's positive. And the moving average is going up. That's also positive. But we're starting to come down and flatten out a little bit as the S&P has been setting a new all-time high. Down below, this is another version of the boom indicator, which tries to measure how far away we are from the moving average. It's not totally accurate, but it gives us an idea of where we're at. We're getting a high reading here. We could still turn and go up from here, but at the same time, when we get too far away from the moving average, we have a tendency to come back to that moving average. And this is another thing. We're hitting all-time highs with the S&P, but the advanced decline ratio is actually going down. We're still positive. We're just a little bit negative in the short term with the blue line, but we're positive but declining here with the more intermediate term measure. This is quite positive though. The vortex, the green line's going up and the red line's going down. So that's looking pretty bullish right there. But then we're seeing this, the cumulative advanced decline line for the S&P based on price and volume, setting an all-time high with the S&P, coming down a bit here with these two measures. A little bit of a concern. And we're below average with volume on Friday. We have the biggest economic report of the month with the employment situation report. And it's like, okay, we were just below average and we ended up setting an all-time high here. And we've been drifting off a little bit with volume. This is an oscillator, but it also has been coming back up too. On up days, we want to see above average volume. Then the parabolic SAR, when the dots are underneath, that's positive, and that's what we see right now. Bullish percent index above 70, and it had been going up here. We're chopping and seeing a little bit of a decline right now, which is a concern. If this continues to go up, that will be positive. If we continue to fall, that will be more negative, and just something we're keeping an eye on here. We're also seeing a bit of a decline here with the NYSE bullish percent index, and we're flat, but well above 70 with the NASDAQ 100 bullish percent index. This is positive, suggesting these readings are strong, but if we continue to go up and this goes sideways to down, that's another little warning sign we're watching. And we look at a ratio between staples and the S&P, and I stopped showing this for a while because we were just kind of bouncing around. I wanted to show it here because when this is going down, that means the S&P is outperforming staples. Staples are more defensive, and the S&P now is in more growth mode, and we're starting to go back down again with this ratio after we had been going up. That is more positive. And then we look at the broader market, the NYSE advanced decline line. Doing really well, but seeing some weakness now, but we're still above the moving average, and both moving averages are still going up. And we look at it based on common stock, also coming down based on price and volume here. Just a little bit of a concern with the S&P setting all-time highs. And we're seeing a little bit of weakness across the advanced decline line. We're still positive with the NYSE common stock since we're above the moving average, but we have been trailing off here. Also trailing off with the S&P, coming down a bit with the mid caps, and we're flat, but we had been higher than this with the small caps. This is just looking internally inside of these indexes, and it's seeing some weakness that's developing. Again, this could get dealt with some good positive days, but it also could be a warning sign. And we look at a ratio between the S&P 500, which is a weighted index, and then an equal weighted version of the S&P. And as we've been seeing the big stocks really outperforming, we're seeing this ratio going up after we had been chopping around quite a bit. Then this is a new concept behind Dow theory. Traditional Dow theory uses the Dow and the transports, and I also include utilities. Well, that's kind of old now. maybe instead of using the Dow, we should use the S&P 500. And instead of using the transports, we should use the NASDAQ because that's more tech oriented, where the transports, when it was created, were mostly railroads. Well, we're setting an all-time high with the S&P, and this is being confirmed by the NASDAQ setting an all-time high here. So this is a confirmation. Where we see a little bit of a discrepancy is when we break this down in the equal weight version of the S&P. See how it's been going down a little bit as the S&P's been going up? But we're coming down with the equal weight version of the QQQs, but it's coming off of a recent all-time high. But this is not confirming what we're seeing on the other charts. The Wilshire 5000, a broad market measure, looking really solid right now, as is the total US stock ETF. Both of those are quite positive here. The NASDAQ setting an all-time high, and we're positive another way because we're above this R1 level. These pivot points, which are pre-calculated, and we know they're there before price even gets there or time even gets there, we were having a little bit of trouble breaking through this back in November. Well, then November ended and we've been able to get above this pivot point, at least for right now. Can we stay above that? And if we do start to fall, will this end up acting as support? Seeing pretty much that same thing with the NASDAQ 100. Above this pivot point level, breaking here. If we fall down, will that provide support? But also setting an all-time high on Friday with the NASDAQ 100. And the momentum for the NASDAQ 100, which had been negative, is now switched over and has gone back to positive. Small caps, which this is the time of year coming up into the middle part of December through the end of the year into January. This is supposed to be the golden time for small caps, but we're still kind of seeing what we've been seeing over the last year, where small caps really zip up and then give back, zip up and then give back. Well, we zipped up here and then they've been giving something back right now, not really showing an awful lot of strength, and they were actually down on the week. And we look at the Russell 2000 small caps. This first index is an S&P index. This is the Russell 2000 small caps. Still above 50 with the RSI, but we've been drifting off here, well above the 50-day moving average though. But in the short term, the momentum has now turned negative. But when you look internally here, the index is not doing all that great right now, but the growth to value ratio is really improving. We're still in a downtrend, but if this continues to go up or stay above both of these lines, we will see a golden cross here, and that would be more positive for the small caps. Then we look at a ratio between the small caps and the S&P, still in an overall downtrend. We've seen short little periods where the small caps seem to really be bouncing back, but not really showing any real follow through right now. The mid caps also going up, looking strong, but then trailing off over the past few sessions. But when you look at the S&P, or excuse me, the mid cap growth to value ratio, showing a real improvement here as well. Not quite to a golden cross yet, where the index has been going down. We're seeing this ratio going up. Then we look at another ratio between the NASDAQ 100, which are the QQQs, and the IWM, which are small caps, right around this blue line again. You know, the perma bears, they thought we were going to come right up here, hit this, and then turn and just tank after that. That's not been what's happening. We spent a considerable amount of time above this blue line, but we're right pretty much at this blue line again. So things are holding up this way and looking positive. And then we also look at not only staples to the S&P, but the staples to the tech sector. And this is starting to go down again and resuming a downtrend. And that's positive. That means that staples are underperforming the tech sector. If this continues to fall, that will be more positive. If it starts to go up, that will put more pressure on the tech sector, meaning that it's underperforming, which will probably put pressure on the S&P as well as the NASDAQ 100. The FANG index, which had been lagging, we were really shooting up last summer, and then we just kind of were going along here. We were positive all along the way. And these are the mega caps: Facebook, Apple, Amazon, Netflix, Google, Nvidia, stocks like that. Well, lately they've been breaking out, and that's where we're getting the real power from right now. And this is now setting an all-time high. But when you look at this short-term trend line, we're coming right up to this. Now, I drew this on here, and I have to eyeball it, so there's nothing perfect about it. But we'll have to see. Is this going to produce some kind of overhead resistance? And looking at another ratio between the broad market and 3 to 7 year bonds based on price, pulling back a little bit in Friday's session, but looking pretty solid overall. Just shows that the broad market is outperforming the price of bonds. The S&P 1500, another broad market measure, looking at shorter term bonds here, 1 to 3 years, also still looking really solid. And the tech sector, after it spent a lot of time at the upper end of the rainbow, it was still positive, but now it's starting to break out a little bit. If this can continue, that would be more positive. A weekly chart of the NASDAQ 100 looking really solid here, going back to 2009. Another ratio between the NASDAQ 100 and the Dow holding up and looking quite solid. And then we are seeing a drop in the 10-year yield, and that is more positive for stocks if that can continue. If interest rates go back up, that might be more pressure on the indexes. Then we look at another ratio, and when we're going up and looking solid like we are now, this means that the market is anticipating a soft landing, meaning that we won't go into a recession. And that's what we've been seeing for quite a while now. But there's other folks that suggest that we might go into a recession. So we're watching things. There's a lot of charts, and there's videos that I post on the website that update kind of on an as needed basis to see, are we looking to go into a recession? We also look at the Qs, the 3 to 7 year bonds, looking really solid right now. Then we look at the negative side here. We're hitting all-time highs with the S&P, but the 20 period, 50 period, and 200 period moving average study calculated on the S&P itself is actually going down. The McClellan oscillator. This is a short to somewhat intermediate term indicator. Dropping below zero, that's negative. And when it's negative, the summation index is turning down based on price and volume. This is a primary indicator in my definition of that. And this is a concern. We're seeing this going down right now. We're also dropping below zero with the NYSE McClellan oscillator, where we had been positive. So when that's negative, we're starting to roll over with the summation index for the NYSE based on price and volume. Little bit of a concern here. Swenlin trading oscillator, not quite a primary indicator, but a little bit more important than a secondary indicator for me. This has been declining as the S&P has been going up, both based on price and volume, to the point where we dropped below zero based on price. And after Friday, we actually dropped below zero based on volume. So another warning sign that we might see some weakness. And now this is kind of telling two different stories. The price momentum oscillator. This was developed years ago by a gentleman named Carl Swenlin, and this is his main momentum oscillator. And I use it. Well, he's done a lot of additional studies for how are things going inside of the S&P when using the PMOs, the basis for these studies. When you look at this by itself, yeah, we're clearly positive here. But when you break it out based on price and volume, you see how we're rolling over? This could suggest some weakness, at least in the short term. And there's some studies here where the PMOs that are rising actually going down. The number of PMO buy signals going down as well, and we're rolling over with the PMOs that are above zero, suggesting internal weakness in the S&P. Chaikin money flow, another smart money indicator. We're looking quite positive with the accumulation distribution. This one, however, is starting to go back down and the red line's rolling over. We're positive because we're green, but the context is that we're declining. And so this is actually looking a little more negative right now. And then another smart money indicator, the Chaikin oscillator, after getting a really high reading above this red line, now it's starting to come back down. And the context is that it's declining, and for right now, that's more negative. And we look at the S&P 500, which is going up, and then the NYSE advanced decline line, two separate things. But this gives us an idea of the S&P versus the broader market, where we're seeing the advanced decline line going down as the S&P has been going up, a bit of a negative divergence. Then we look at the S&P 500, which is a weighted index, and compare it to the equal weight version. The S&P is going up as the equal weight version is going down, a bit of a negative divergence here. And we're actually crossing below 50 when we look at those stocks inside of the S&P above their 20-period moving averages. That's turning this more negative in the short term. We're not seeing that reflected in price, at least yet. This is the internal things that we look at. We're also declining with the 50-period moving average, 100-period moving average, and 200-period moving averages here. They're still positive. They're still well above 50, but they are declining as the S&P has been going up. Then another thing here, home construction and then a ratio to 3 to 7 year bonds. It had been doing quite well, but now we're starting to come back into the rainbow. If this can turn and go back up, that will be more positive. If it continues to fall, that will be more negative. This is an area that's causing some concern. The semiconductors, which are a massive part of the tech sector, which tech is a massive part of the overall market. We're seeing a recent death cross here. This is when the 50 period moving average crosses below the 200 period moving average. And that's a pretty big deal. Now, we've been bouncing back up a little bit here, but we still are below both of these moving averages. If we see follow through weakness here, that could really suggest some negative action. Man, this is a brand new chart. I haven't even shown this in the daily videos. I just created this over the weekend. This is a ratio of the semiconductors to to tech. And when this is going up like it was earlier in the year, that means the semiconductors are really outperforming. And we stalled out over the summer. And even though we're doing really well, tech sector's doing well, the semiconductors are really starting to underperform. And we're seeing this ratio really going down right now. And that's a concern. And then we look at another ratio, semiconductors to the Dow. This is not really falling apart, but it's not really showing a lot of strength right now either. Then these are areas that I'm watching, and this is the skew index. And there are people out here who also follow the skew index and they have an opinion about what will happen. I don't, because you can see here when this gets a really high reading, and this is the highest reading we've seen in a long time with this chart. The market is expecting some kind of a big move. But if you look at these spikes, sometimes it was a top, sometimes it was a bottom, sometimes it was just a continuation. So we don't really know. It could still be a break to the upside, but when we look at it in the context of some of the internal weakness that we're seeing, it may mean that this comes down if we see the S&P decline. But if the S&P goes up and this declines, then that will have to change our focus. We also want to keep an eye on weekly jobless claims, which for the most part had been declining. Well, we saw them spike back up in the previous week. And then we're seeing the continuing claims, which have been going up, they're actually starting to decline now. The real problem is if we go back here, if we see initial claims going up and continuing claims going up together, week after week after week, that's when we get more concerned. Right now, we're just kind of seeing a battle back and forth between the two. We want to keep an eye on oil. We watch it for a number of different reasons, but lately it's been for geopolitical reasons. But the market's pretty much ignored that. There's a lot of geopolitical stuff going on right now. The things in Israel and the whole Middle East, Russia, Ukraine, France, South Korea. The market's ignoring all of that stuff. And we're actually declining here when we look at oil, but we just keep an eye on this. And the dollar did see a recent golden cross here. It's kind of funny how this works. We were really going up, saw a golden cross, and now we're pulling back. And that's what happens. That's one of the drawbacks of using moving averages now. But we are in an overall uptrend. And then some seasonal things to keep in mind here. And I showed this a week ago. I've been showing it in the daily and weekly videos. Going back to 1950, the S&P is up almost 80% of the time when you go the Tuesday before Thanksgiving until the second trading day of the new year, with a return of 3.78%. The small caps, this is when they are usually seeing a lot of favor. They're up almost 78% of the time with a average return of 5.12%. But it doesn't mean this is 100%. It doesn't mean it always happens, but it just means the odds are in favor of it happening. And then this is a daily chart put out by Stock Traders Almanac, where we saw positive seasonality throughout the first week of December. This is what I'm talking about through this week. Now, Monday looks pretty good, the 9th. But then after that, we tend to see some negative seasonality going through until the early part of next week. And then it's later on in December, this red dash line here, these are the small caps, and this is when they really start to take over. Now, we don't know if it's going to play out like this. This is just what has historically happened, and we're wondering if we're getting set up for something like that to happen. But in the meantime, are we going to see some short-term weakness before this strength could come back into the market? Then we have a thing called the Hindenburg Omen, and the perma bears love this thing. This What you see here is just an explanation, and there are three criteria that need to be met for the Hindenburg Omen to be valid. Right now, we're only seeing one spike right here. And stockcharts.com, they took those three criteria and put it into this one indicator, which makes it a lot easier to do. It makes it so you don't have to interpret things yourself. You can just look at, oh, here's the chart, and this is what it's telling me. Well, we had the initial signal that was generated on November 20th, and now we have until December 19th to get another spike up here. It hasn't happened yet. Other times when we saw a lot of spikes. This was right before the COVID crash. This was right at the end of 2021. So we're waiting to see. But right now, there's not been a confirmation. Thank you. I hope you found this helpful. Have a wonderful weekend, and I will talk to you in the next video.